I'm Jim Falk here in Santa Fe, where I am on the board, and I am so pleased to welcome a good friend, Sebastian Mallaby, to this month's edition of Cover to Cover. This is a monthly production of the World Affairs Councils of America, where they highlight some of the most interesting and important books that have come out, and this is certainly one of them. For more information about the World Affairs Councils of America, just go to its website at worldaffairscouncils.org. And I hope that if you're not yet a member of a council near your neighborhood where you live, just go to the website and you'll be able to find one very close, I hope. Sebastian is the Paul A. Volcker Senior Fellow for International Economics at the Council on Foreign Relations. And I want to encourage all of you, if you're not subscribers and see his regular columns in the Washington Post, you can probably sign up directly with Sebastian through the Council on Foreign Relations or with the Washington Post. We're here today to talk about his most recent book, the fifth book that he has written, and it's called The Power Law, Venture Capital and the Making of a New Future. It's a fascinating read, and it's well written, as you might expect, for someone who has spent 13 years writing for the newspaper, or The Economist, as it is called. Sebastian lived in the United States for quite a long time, where he, for a period of time, was bureau chief for The Economist Washington, D.C. bureau, and he wrote one of my favorite columns, The Lexington. And I have to add, for those of you who know me, Sebastian is an avid cyclist who came to Dallas and we started talking about cycling. He was bragging about how he was going to San Francisco, and I said, hey, we can arrange a ride for you in Dallas, but now I want him to come to Santa Fe. Welcome, Sebastian.
Thank you, Jim, for that intro. And it's all true about the biking.
Absolutely. So let's get right into it and talk about the book. The title of it, what is the power law?
Yeah, so the power law is probably best explained by starting with what it isn't. We're familiar with that bell curve in a so-called normal distribution where most of the observations in a data set cluster around the average, creating that bell curve in the middle. So if you think about the average height of an American man is 5 feet 10 inches, and 2/3 of all American men are within 3 inches of that. And even a 7-foot tall NBA star is actually only 20% taller than that average. So that's a normal distribution. Now, a power law distribution is very different. You've got, let's think about an example, the wealth of American men, right? So there, the median American man is way off the sort of the equivalent of the NBA star. Think about if Jeff Bezos is watching a movie and walks out of the back of the movie theater because he's bored halfway through, the residual American men in the movie theater, their wealth is going to plummet on average, right? Whereas, if the NBA star walks out, it will hardly make any difference to the average height. And so some phenomena like wealth, you've got these people in the right-hand tail of the distribution, who are numerous enough and their wealth or their something else, their success, is like so huge that it distorts the average and pulls it away from the median. So, 80% of the people live in 20% of the cities. 80% of the academic citations probably accrue to 20% of the academic papers. And in venture capital, nearly all of the profits come from a few outlier bets. A venture capitalist might have, money to make 10 bets. 9 of them might go to zero, and one might make more than 10 times the capital invested. And so all of the returns are in this extreme right-hand tail of the distribution.
I think it was your second or third chapter, and it was titled Finance Without Finance. And years ago, I was a commercial banker, and you don't want to make bad loans, you don't take risks. And yet in venture capital, risk is acceptable. If you're not a risk taker, if you're not going for the grand slam, you're never going to be successful. Elaborate on that.
Sure. I mean, so many things about venture capital are fundamentally different to other kinds of finance, which is why it was sort of intellectually attractive to me to try to get my head around it and explain it. If you value any kind of asset in the public market, you normally start with a cash flow, whether it's a bond or a public equity. You look at the future cash flows and you discount them. Well, with an early stage startup, there is no cash flow. They have no earnings yet. They have no price to book ratio because there's no book value. The startup won't own any land or factories or machinery. And so all of the normal metrics don't work. And that includes the whole attitude to risk. As you were saying, Jim, if you're a commercial banker, the notion that you would lend money and then get zero of it back would be career ending. But in venture capital, most of the bets you make, you will get zero back. It's just totally normal. And where you are bailed out is by those outlier right-hand tail power law returns that do so incredibly well that they make up for those many losses.
So what is the origin of venture capital? And it started off really being called adventure capital, right?
Yeah, I mean, there were always sort of a few people who were attracted to the idea of long shot bets on inventors or on risky endeavors. So you could say that, whaling in Nantucket way back in the 19th century, where the sea captain raised money to put the boat together, and the people who put money behind the boat and the expedition took a share of the upside if the whaling venture was successful. I mean, that was kind of a adventure capital as well. I date the proper start of what we now recognize as venture capital with the arrival of a character called Arthur Rock, who came to California from New York to finance Fairchild Semiconductor. And this was a semiconductor company started by 8 so-called traitors because they were leaving another semiconductor company. They didn't like the boss, Shockley, and they quit and they wanted to do something different and be hired by somebody else. And this man, Arthur Rock, showed up and said, don't go be hired by somebody else. You can start your own company. And they said, but we don't have the capital. And he said, well, I'll raise the capital. And he put together the financing for them to do their own company. And they were known as the Traitorous Eight, because in those days, in the 1950s, the classic business book was Organization Man. And it depicted this lifelong loyalty to the corporation, working at one place and working your way up the hierarchy until your 60th birthday, when you would retire with a gold watch. And the idea of leaving a company early and starting it, was an act of being a traitor. And Arthur Rock made this act of being a traitor rather more common because he financed several startups. And as people copied his success, being a traitor became perfectly normal, and traitors became renamed entrepreneurs, and a whole new culture was invented.
And why California at that point?
Yeah, that's a great question. When I began my research, people said to me, Silicon Valley is really Stanford Valley. It's sort of the outgrowth of this amazing university, which both had fantastic engineering, but also a sort of permissive attitude to people who wanted to leave for 5 years and try their hand at doing a startup. And as I looked into that, it simply was not an adequate explanation for Silicon Valley, because in the origin of the story in the 60s and 70s, MIT was clearly a stronger engineering university than Stanford was. And if you want to add in Berkeley to the Northern California story, well, I can add in Harvard to the Boston story. And Harvard was better than MIT, and Harvard was better than Berkeley, and MIT was better than Stanford. So it's not about the university, nor is it about defense contracts, because actually more of the military-industrial complex spending flowed to the MIT Boston ecosystem than it did to Northern California. And so the theory I landed on is that Northern California was distinctive because of the venture capital there, because Arthur Rock came and set up this new model of financing where he understood the power law. He was willing to take very, very risky bets, and accept that many would lose, but would be backing some that just went incredibly well. And that culture was imitated by Kleiner Perkins and Sequoia, two storied venture capital companies that started in 1972. And they together funded companies like Apple and Genentech, Tandem Computer, Atari, the first video game company. And that just set a sort of flywheel in motion. So it was really, I think, the venture capital that made Northern California distinctive.
We had the opportunity for listeners to go ahead and submit some questions in advance. And here's one from Yeli Saka. Are there other regions outside of Seattle, Silicon Valley, and New York that are influencing virtual capital? And I know, from Dallas, I mean, there was a real effort in Dallas and continues to be an effort to attract more venture capitalists. So what makes it successful for a city to acquire more?
Well, until about the year 2005 or thereabouts, Silicon Valley seemed to have a pretty much a lock on doing this kind of financing. Even Seattle did not have much. Amazon, of course, the famous anchor of the Seattle ecosystem, had actually been funded by a Silicon Valley venture capitalist, John Doerr of Kleiner Perkins. So Bezos had come to Silicon Valley for his financing. And equally, New York had a little bit of venture capital, but not very much. And most of it was not really as risk-taking as the Silicon Valley kind. And the same went for Boston. So really, Silicon Valley had a monopoly, but then it changed. And around 2005, Silicon Valley venture capitalists started to kind of set up offices in other places. They moved into China in a big way. And they started to get on airplanes more and be willing to fund stuff in other parts of the United States. In 2006, some of them started going into India and Southeast Asia. And a bit later, they started moving into Europe. And so essentially, this secret sauce has been bottled and exported. And now I believe that venture capital is really spreading worldwide. It's been astonishing to see how in the last decade, it's spread into India, for example, and really transformed Indian attitudes towards entrepreneurs, just like there used to be traitors in the US in the 50s, and then they became entrepreneurs. The same thing has happened in India in the last 10 years. So it's been a pretty dramatic change.
What about China, however? Because China was going through this phase of rapid entrepreneurship, and now you're seeing Xi clamping down on that. How is that affecting venture capitalists?
Yeah, I mean, that's a very much a topical question. The extraordinary thing is that the origin of the Chinese digital economy really was a sort of an American venture capital story. All of the early Chinese successful companies like Alibaba, Baidu, Tencent, Sina, Sohu, NetEase, you name it, they all had American-style venture capital with Silicon Valley lawyers doing the work and dispute settlement under New York law. So it was the export of the entire VC playbook from Silicon Valley that made it work. And so by extension, my view is that when the Chinese government comes along and starts, kind of imposing its will on the digital economy, that is not intelligent sort of industrial strategy, which some people would say, the Chinese state is very far-seeing and it's going to guide venture investing in a better way. I actually think that the origin of the digital economy was primarily in a sort of American playbook in China. And when the government intervenes, it's going to just, it's going to prevent VCs from sort of going out of their lanes. The government is going to be saying, listen, we're happy with artificial intelligence. We're happy if you want to invest in semiconductors because these are strategic priorities for us, but we're not so keen on other things. And VCs will then sort of have their heads down just doing what the government wants, and they won't be looking for the new thing. And I think over time, that's going to impede the inventiveness of the Chinese startup sector.
And there'll probably be a flight of capital, I would assume, as well.
Yeah, I mean, there is momentum enough in the Chinese startup ecosystem that it won't evaporate altogether, overnight. And part of the nature of startups is that when you invest in them, you're locked in for 7 years because they're not going to go public for quite a few years. And so you won't get a return for a while. So the venture capitalists who are active in China have a lot to lose. They can't just sort of pack up and leave. But what they could do is they could advise their kids to make their careers elsewhere. And I think over time, you'll see that attrition. Actually, I had an email just yesterday from a founder of a big, huge Chinese tech company who I got to know when I was writing my book. And he was sort of lamenting the difficulty in making investments outside of China now, because the whole attitude towards Chinese venture capital and Chinese technology has changed so much in the outside world with the rise of geopolitical competition.
You've touched on this a minute ago, but I'd like you to elaborate. I mean, one of the things that makes your book so interesting is some of the anecdotes, and essentially, many of the companies that venture capitalists invest in is they're looking for that grand slam, and it's just an idea that perhaps makes no sense or is so far out there, like meat that tastes like meat that's not meat.
Yeah, I mean that's sort of the leading story in my introduction. Has to do with this sort of slightly eccentric Stanford professor, and he was a Stanford professor. It's not that many of these companies get started by Stanford professors. Just to go back to my earlier point about not necessarily everything. Anyway, but this character was a Stanford professor, and he was a renowned geneticist. But he was also somebody who cared a lot about climate change, and he took a sabbatical and started thinking about how he could make a hamburger that not only tasted like a hamburger, but smelt like a hamburger and looked and behaved and squished like a hamburger. And when you put it on a grill, it would go from red to brown and make that satisfying smell as the juices dripped onto the hot coals. He really wanted to sort of imitate every single aspect of a hamburger. So he broke this down into sort of 4 or 5 different science problems. And he figured out that that smell of the juices dripping came from the smell of, heme in the blood, in hemoglobin, dripping onto the coals. And he figured out you could find heme in certain plants like clover roots. And he started digging up clover roots in his back garden and dissecting them and slicing them up and seeing if he could generate enough heme for that property to be mimicked in a plant burger. And he took this idea to a venture capitalist on Sand Hill Road, and just a short bike ride away from the Stanford campus. And he got the funding, and he called his company Impossible Burgers, and he made the impossible possible. And today you can eat an Impossible Burger, and I highly recommend it. It does taste rather good. And so, that's an example of something where the venture capital investor thought, this probably only has a 1 in 3 shot of actually working. But if it did work, it would be so transformative, both in terms of the profits you would make, but also in terms of just helping the planet, that of course you should fund it. And so Vinod Khosla, the venture capitalist, did back it. And 7 or 8 years later, these were being served in restaurants.
So how much money did he put in, and what was his return?
Yeah, my memory is that he put in about $3 million at the beginning. And I think the return would be at least 50 or 60 million. So he made a comfortable profit.
So Pat Ryan from Tennessee asks this: Nashville has landed a new large Oracle campus. How much energy should we expect that to generate from other companies moving in? Do you see like a leverage when that happens?
Absolutely, I see leverage. I mean, if I just look around Europe, just to take an example of where I happen to be speaking to you from, the fact that Google and Microsoft and Apple and Amazon and all these characters have set up research centers around Europe is fantastic, because after 5 years, the researchers there catch the entrepreneurial bug, and they leave their research job with Google and they do a startup, which they do locally. And the venture capitalists are delighted to back somebody who used to work for Google, because that's a terrific credential. And it does create these spin-off effects. And so I'm very optimistic about anywhere that gets an Oracle research park.
Again, one of the themes of your book is how a marriage works between the venture capitalist and the entrepreneur. And it really is a symbiotic relationship that sometimes gets off the skids, but it has to work for the company to be successful. What and you talk about the development of venture capitalists in working with entrepreneurs. I'm not sure which example you'd want to talk about, but pick one where you really do see this evolution of the relationship between the initial investor and the entrepreneur.
Well, there are some which kind of make the point about the investor's input because it actually had an unhappy outcome with the entrepreneur. So if you take Cisco, which was the dominant maker of routers, all through the 90s and into the early 2000s, Cisco was begun by two brilliant but eccentric characters who had the idea for a multi-protocol router that could connect different local area networks into one single network and therefore lay the basis for what became the internet. And they, invented this product, began to build it, but they were such contrarian people that they really couldn't put together a team of others to scale the company with them. And they took investment from Sequoia, from this character, Don Valentine, who was not afraid of difficult characters and had been a former Navy water polo player, such that his physical presence complemented his intellect in telling people what to do. And he was not shy of telling these two founders how they were going to build the company more successfully. And he essentially took over control of the company, ended up firing one of the two founders, and then the other one quit in sympathy. And, really Cisco was built not by the founders, but by the venture capital investor, who put in an entirely new team: the CEO, the vice president for manufacturing, the vice president for engineering, the vice president for sales and marketing. The whole thing was created by the investor. And so that really does make the case. But I think there are other cases where really the function of the investor is to be the superconnector who links a brilliant entrepreneur to the wider ecosystem. And this function of linking is very, very important. I read this paper by Mark Granovetter, a sociologist, which is one of the most cited social science papers of all time. And it makes this case for the strength of weak ties. The idea being that in your professional life, if you have lots of weak ties to different people, that will create more opportunities for you and bring you more ideas than if you just have a few strong ties. What a venture capitalist is somebody who is always meeting other people, partly in order to find the next startup to invest in, partly to find the 5 early engineers who could be hired to work for the startup that the VC invested in last week, partly to find customers that the companies that the VC is backing could sell to. So a venture capitalist is somebody who gets up in the morning, has breakfast with one person, and then 14 cups of coffee, hopefully decaffeinated, before going to bed. And by buzzing around the ecosystem, the VC is connecting up the ideas and the people and the capital that run these iterative experiments called startups to try out a way of building the new thing. And many of the experiments don't work, but some of them do. And by circulating the money and the people and the ideas, you get to try lots of experiments. And that's really the key reason why startup clusters that feature lots of venture capitalists are more productive than those that don't.
So here's someone I think who wants to perhaps move to Silicon Valley. Raul Sumat asks, In the post-COVID world of working from home conveniently, would you recommend that professionals move out to Silicon Valleys of the world if they want to get into the startup world? And let me do a follow-up with that. Talk about what type of person a venture capital firm hires. You used to, and perhaps it's still that way, that people went to Ivy League schools, and their first job they wanted to go work for an investment bank. How does someone, and what qualifications do they have to work for a venture capital firm?
So I think, first of all, on the question of where to go and do it, I mean, Silicon Valley remains the epicenter of the startup world, particularly if you're talking about IT. If you're talking about health sciences, Boston is a very strong contender. And then there are other, particular kinds of startup. Maybe fintech is strong in New York. So it depends a little bit which type of startup you want to do. Things have spread out. So during COVID, both Austin and Miami did very well. And Boston and New York certainly have their own startup clusters. So you don't have to be in Silicon Valley, but it remains the center. And Jim, in terms of your question about what kind of qualifications, I would say that many of the venture capitalists I met and interviewed and got to know had 2 out of 3 of the following qualifications. The 3 are to have worked at a startup that did reasonably well, maybe as the founder or maybe as one of the early employees. Second thing would be to have a technical expertise, so a degree in software engineering or some other form of engineering. And thirdly, to have a business degree. A few people I met had all 3, right? They had done a master's or an undergraduate degree in electrical engineering. They had worked at a startup. They had gone to a business school, typically Stanford or Harvard, but it doesn't have to be those 2. And then they had become venture capitalists. You also have to be an extrovert. I mean, when I did my book about hedge funds a few years ago, there were plenty of people who were rather introverted and rather analytical, and they sat behind their bank of screens, a bit insular. And if they made a lot of money and they bought a private island, it didn't make any difference because they were already so insular. In venture capital, you've got to be a super connector, as I was saying. And so you have to like talking to people.
Yeah, I know that a venture capitalist expects to have some failures, but let's talk about some of the big ones. WeWork, um, the evolution of that, or the Theranos.
Um, I'd like to make a distinction between the 2, Theranos and WeWork. Theranos is a specific kind of failure. It was outright illegal fraud in a regulated industry, healthcare, where the company had data on what the test results could tell you and what they couldn't tell you. And the company just lied about what it had.
But it didn't start out as fraud. I mean, she had the idea and raised the money.
That's correct. That's correct. So the early stage of Theranos, when it was just an idea, is a typical Silicon Valley story. And when you're laying out the idea and you're painting a bright picture about the future, and you're telling what the Silicon Valley types call a premature truth, that is not fraud. That is just, an optimistic story about what you might be able to accomplish if you get the money. And I think that's fine. Everybody in Silicon Valley understands that, a dream about the future is just a dream, and you're backing a vision. You're not backing reality. But when you've been in business for a while and you've actually developed the product, so-called, and you are actually using it on people, and you've got, test results that you lie about, that crosses a line from being a premature truth into being flat out fraud. And that's why I do think it's important to say that Theranos is not the typical story of a Silicon Valley premature truth. It crossed a line. And it's revealing that although there was one particular proper venture capitalist, Tim Draper, who did back Theranos right at the beginning, with a check for, I think, $500,000. So that was a seed stage check, as it's called, just backing the vision. And I don't think there's anything wrong with that, just backing the vision. And when venture capitalists write a seed stage check, they're making lots of them. They don't do a lot of due diligence. They just say, oh, this young person seems to have commitment to an idea that's intriguing. Let her go and work on it, and we'll check back later to see if it's actually working properly. The people who wrote bigger checks to Theranos, who really enabled the mature company to carry on in business, these were not venture capitalists, they were venture tourists, people who wanted a piece of the excitement of Silicon Valley. They were the Walton family of Walmart fame, they were the Murdoch fortune, they were Carlos Slim of Mexico, who made his money in telecoms. So they were not classic venture capitalists. And indeed, when Theranos tried to raise money from classic venture capitalists, the founder would go in, Elizabeth Holmes would go in and see the venture capitalists, and after not being able to answer the fourth question, she walked out in a fury in one case.
And leave empty-handed, right.
Empty-handed, precisely. So I think, Theranos was not a classic venture capital story, not a classic Silicon Valley story. It was outright fraud.
So what about WeWork?
Yeah, WeWork was closer to a normal VC deal because it got a Series A investment, not a seed investment, from Benchmark, which is one of the absolute best Series A investors. And then later it went off the rails. Now, it went off the rails because of a pervasive problem with Silicon Valley tech companies in the late sort of 2010s, which was that they started off okay, and then they raised tons of money from so-called growth investors who wrote very big checks and who didn't really have Silicon Valley DNA again. So in the case of WeWork, it was JP Morgan, it was T. Rowe Price, it was other banking institutions that were not typical venture capital investors, but wanted to have a piece of the action when WeWork ultimately went public and maybe underwrite the IPO and make a lot of fees from that. So I think JP Morgan was guilty of this thing that investment bankers sometimes do, which is to have one line of business which is a loss leader, and then hoping to really make the money with the other line of business that comes later on. And I think that's why WeWork was permitted to go off the rails. Another case would be Uber, which started out very well. Again, Benchmark backed it. Later on, went off the commercial and moral rails, had all these scandals around abuse and harassment, law evasion and all that stuff. And the founder had to be fired. And again, this was a story about how governance broke down once the later investors came into Uber and failed to exercise due diligence, failed to go on the board and restrain the founder when he started to go off the rails. And my conclusion for all of this is basically in American capitalism, there are a few models of decent corporate governance. There's a public market model where if the managers do something stupid, people will come and short the stock, and then the stock will go down and somebody will make a takeover bid and the incumbent managers will be kicked out. That's, we can debate if that's really working very well, but at least it's a model, okay? Then there's an early stage venture capital model where the founder invests, the founder goes on the board of that startup, the founder watches, and if the investor watches, and if the founder is not doing their job properly, like in Cisco, then the investor, the venture capitalist, kicks out the founder and installs a better person to run it. That's a workable model of governance. Finally, there's a private equity model where you take control of the whole company and the private equity company is very much invested in making sure it's properly run. But what does not work is when the early stage startup founder becomes the imperial CEO with super voting rights and nobody's really overseeing the founder or the CEO. And that's what happened with Uber and with WeWork, and that's a problem.
So why did JP Morgan accept that? Were they in a negotiating position and they had to?
I think JP Morgan accepted it because they viewed, in Jamie Dimon's words, they viewed the investment and the equity of the company as the beachhead, and they were going to send in their Navy SEALs afterwards to do things like lend money to the company as a commercial loan, to lend personally to Adam Neumann, the founder, which they also did. They financed mortgages that Adam Neumann wanted, and then to do the IPO. And so the VC investment that JP Morgan did was a loss leader. And that's not a good model. It reminds me of 2007, 2006, when you had these crazy, lending and securitization of collateralized debt obligations. The people who did that, like Lehman Brothers, were intending to sell the collateralized paper out the back door to other investors. And so the business of securitizing the bundle was just the loss leader that you did in order to be able to sell it to other investors. And that's where you get problems. It's when you do something without paying attention to whether it's sensible, because it's the loss leader to your other business, which you're going to make a profit on. And that's what happened with JP Morgan's involvement in WeWork.
Let's bring Margaret Hill into the conversation. She's with the World Affairs Council in Southern California. What types of businesses gain the biggest share of venture capitalist attention and why? And I think in your book, you talk about how that's changing.
Yeah, right. So in the early years of my story, in the 60s and 70s, there were semi-conductor companies like Fairchild and Intel. There were computer makers like Apple and Compaq. There were other kinds of hardware business that made routers like Cisco or other sorts of hardware. And then later on in the 90s, the book shifts and my stories become dominated by software companies. And software was highly seductive for venture capital because with relatively little capital, you could scale very quickly to millions and millions of consumers and make extraordinary returns. And so Google demonstrated this, Facebook demonstrated this, all kinds of software as a service, enterprise software companies have demonstrated this. And that was just, a very, very profitable business line for venture capital. And I think the issue now is whether venture capital can rediscover its roots and go back to investing in hardware. I hope it can, because the hardware includes batteries for electronic vehicles and other forms of environmental investments. It also includes healthcare, and I think there's enormous potential right now to build great businesses off the back of all the fantastic sort of genetic testing, the sequencing of the genome, the dramatic fall in the cost of doing genome sequencing. There's just been an announcement you can get it for $99 now to sequence a genome when it was costing, whatever, 100,000 10, 15 years ago. And so that's a dramatic revolution. You put on top of that mRNA technology, gene editing, CRISPR. I think there's terrific potential to do biotech in a new way. mRNA was a technology backed by a venture capital company. And I'm really hopeful that we get more of this and it'll be the golden age of VC investing in healthcare.
Along these lines, Shanfa Flaga, who's with the World Affairs Council of Mid-Hudson Valley, do you think semiconductor business like TSMC will open a lab or a factory in the United States?
That's a great question, and I've thought a bit about this, but I want to stress it's not really directly a venture capital story, because making these fabs, these semiconductor fabs, is so capital intensive. It's really at the extreme of what venture capitalists can't do. They can do software very easily. They can do these hardware projects like batteries, perhaps. I think semiconductor fabs, they cost billions of dollars. And so I think with the help of the US government, right now there is a bill there's one bill that's gone through the Senate and another bill that's gone through the House to subsidize semiconductor manufacturing in the United States and try to bring it up to a higher level. I think that's a national priority and should be a national priority. So I hope those two bills can be reconciled and sent to the president's desk for signature, because it's not a good situation where 45% of total semiconductor output comes from Taiwan, and 90% of the most advanced chips come from Taiwan, because clearly Taiwan is a geopolitical flashpoint, and the United States should not make itself dependent on that hotspot for critical supplies of semiconductors.
Given your experience, you won't be surprised that we have a number of questions about tax implications. When a venture fails, what are the tax implications? And are we seeing any proposed changes now with the Biden administration that might impact all of this?
Well, the tax treatment of venture capital is, all bound up in the limited partnership structure, which is a pass-through entity. So what happens is that you have a venture capital company which sets up this partnership, and it basically can do the investments without paying capital gains tax itself. But when it passes the successful investments out the back door to its limited partners, the people who originally provide the capital, then there can be capital gains to be paid on those positions by whoever made the investment. Now, as it turns out, many of those investors are endowments that are themselves non-profit and therefore tax-free. So, some people pay capital gains on these positions if they are not tax exempt, others don't. In my view, the tax subsidy that we're looking at there is okay, because fostering innovation has positive spillovers for the economy and for society. I think it's more doubtful when you're looking at the same tax structures being used by private equity, real estate partnerships, and hedge funds. In the case of tech, I'm more okay with it.
I can't figure out what's happening with Elon Musk. One day it's on, the next day it's on hold. And there was an article yesterday in the Washington Post. Elon Musk lines up growing list of investors to take over Twitter. And a number of the investors are people like Sequoia that you mentioned in your book. You wrote a piece just a few weeks ago titled "Elon Musk Still Has to Answer to Others." What in the heck is happening? What should we expect?
But I think what happened with Elon Musk is, first of all, he is an absolutely extreme risk lover. There's a story in my book about how he did a small and not remembered, and in fact not memorable little startup back in the 90s before he was at PayPal, and he sold this thing. I don't know, made $4 million for himself or something. And I think he spent fully half of it, on a supercar, a sort of McLaren that had to be specially made and specially delivered to him. And he took delivery. And then he was at PayPal, where he was, running this payment startup with Peter Thiel. And he drove Peter Thiel down Sand Hill Road to go and raise money from some venture, from risk-loving venture capitalists. And to show off to Peter Thiel, he suddenly jammed his foot on the accelerator of this McLaren, and the thing spun out of control, hit the median on Sand Hill Road, spun up in the air, did a 360, and they landed, grateful not to be harmed, but the car was totaled. And Peter Thiel was white in the face. He looked at Elon Musk, and he said to Elon Musk, "Why in the heck are you laughing?" And Elon Musk was cackling with laughter and then controlled himself and said, "I'm laughing, it wasn't insured." And he'd totaled his, half of his proceeds from his company, and he thought it was funny. That is the kind of person he is. That is why he was later thrown out of PayPal as chief executive, because all of the people who were working for him couldn't stand working for him anymore because he was such a crazy person. So he is a bit crazy, right? And I think what happened is that he was bored. He was only running about three companies, right? Tesla, SpaceX, and the Boring Company, which bores tunnels. And for him, that just wasn't enough. So he thought, what the heck, I'll buy Twitter. And then it turns out that when he bids for Twitter, the first thing that happens is that the value of his holding in Tesla collapses. Now, partly it collapsed because all of tech was collapsing at the time, but it also collapsed because people at Tesla were not so happy at the idea that Elon Musk would be distracted by trying to figure out how to run Twitter as well, right? Now, Elon Musk does care a lot about Tesla. And so I think he looked at this and said, I've destroyed so much of my own wealth in Tesla that maybe it wasn't such a smart idea to go and buy Twitter. And so he sort of started muttering and making signs that he was trying to get out of it. And I think he only wants to do it now if he can, put this syndicate together and basically de-risk the whole thing for himself and not lose face by backing out totally. And by the way, not also have to pay a penalty. He has a big penalty clause that will be triggered if he does back out.
How large is the penalty clause, do you know?
$1 billion, as I recall.
So, Sebastian, as a journalist, how do you feel about someone that you have described as certainly off the charts having such control of a medium like Twitter?
Well, look, I mean, we have a long tradition in the United States of individuals owning media companies, right? And New York Times, Washington Post, they're owned by people, right? Fox News, CNN maybe less so now, but I mean, it was started by one individual, Ted Turner. So I think I'm not against an individual owning Twitter. And I think the good thing is that in the United States, we allow individual tycoons to make a lot of money and, risk it. And basically tycoons, on balance, they may be a bit crazy, but look, Elon Musk created Tesla, which is a fantastic advance against climate change, as well as a great advance in just car technology. He created SpaceX, which has revolutionized the game of putting satellites up into space. So he is definitely a net good for America and for the world. So I'm delighted that we have a system that tolerates Elon Musk and that allows him to spend his money on Twitter if that's what he wants to do. But we have safeguards in place that, the rules around the speech that will be permitted or not permitted on Twitter are partly the government's business. And, Twitter will be regulated if need be. And so that's what we see with speech on Facebook. There is public pressure on Facebook to do things that actually, Zuckerberg didn't want to do initially, and so I'm comfortable with the idea that the US is a great economy because it struck this balance between freedom for tycoons and then the regulation of tycoons. It struck that in a reasonable way. And it's better than, the free-for-all that you would see in a kind of oligarch-driven, unregulated economy. Some petro-state where the rich guys do whatever they want. It's better than that because it's more regulated, but it's not too regulated, unlike maybe Europe has been with respect to tycoons that has, diminished innovation in the tech sector.
Well, do me a favor, don't get in a car with them next time you interview them.
Got it. Thank you.
So I want to talk with you about a negative aspect of venture capitalism, and that is that women, there is a glass ceiling, and although it's improving, what is the percentage? Is it still as low as 16% of women that are active in venture capitalism?
It was 16% when my book was coming out 3 months ago. I don't know if there's more data. Anecdotally, it's going up. I keep on hearing more stories about, a partnership saying we pledge to have, at least half of our partners being women or whatever it is. So that's a good thing. When a profession.
What's the root reason for it, though?
So historically, I think here's the story. if you go back to the 60s or 70s, the fact that venture capital was male dominated is not surprising because, professional life was male dominated all across the board. By the time you get to the 90s, the male domination was surprising. And by the time you got to the 2010s, it was outrageous. And I think, venture just didn't adapt like the rest of society did. And I think it's because it's this very clubby, network-driven business, where, as I was saying, it is about getting up in the morning and having breakfast with one person and then meeting 12 other people in your network before you go to bed. And that kind of personal ties-driven networky thing, you have your network and you tend to stick with your network. And until some external force hits you and forces you to change your thinking, just think about this thought experiment. Let's say there's a venture capital company and at the beginning 2 men start it, and then they hire a third person and they want to make sure it's somebody that they're really going to work well with. So they may hire somebody that one of them knew in college, and maybe that was a man who was, also in the same investment club. And then they've got 3 men and they're going to check out the 4th person they're going to hire. And it just happens that, they are men and they tend to play golf or whatever sport it is with other men, and they know men. And so it becomes more and more path dependent. And, so I think a fact of forming new companies is that the third hire better be diverse. Otherwise you're stuck and you're never going to make a diverse hire. And it becomes increasingly difficult. And I think, that's the explanation. And it took the Me Too movement, and it took the sexual harassment suit that Ellen Power brought against Kleiner Perkins about 10 years ago or so, to really jolt the VC world and to force it out of its comfort zone. And now I think it's gradually catching up.
A story that I thought was really interesting, because you just sort of think of Facebook as in Mark Zuckerberg and all the stories, is how a Russian investor got involved and how hard he had to work to even get attention.
Well, that's right. I mean, Facebook was trapped by the 2008 financial crisis. And so even though it was sort of the hottest premier company, in fastest growing software company at the time in 2007 or 2008 or 2009, it suddenly found itself late 2008, early 2009, not being able to raise the next round of money. And this was a problem because, there were people, early employees, who had made a lot of money on paper with their vested stock options, but they couldn't sell any. And therefore they were rich on paper, but poor in terms of their bank accounts, and they couldn't buy an apartment or whatever. So Mark Zuckerberg needed to raise more capital, not least to keep his own staff happy. And he couldn't do it. And he sent his chief financial officer off to pass the hat in the Gulf states, and even that didn't do the trick. And all of a sudden, the CFO is sitting there despondently in one hacker drive, I probably was already, where Facebook has its headquarters in the valley. And the phone goes, and it's this Russian accent, and this voice says, "Hello, I'm Yuri Milner. I'm calling you from Moscow, and I'd like to invest. And I hear that, from my friends at Goldman Sachs, that you need some money, and I'm happy to invest." And the CFO from Facebook says, "Have you ever been to Silicon Valley?" And Yuri Milner says, "No, I haven't, but I want to invest." And the CFO says, "Listen, I don't know who you are, some Russian person, sorry, I'm not doing this call." And he hangs up. And Yuri Milner puts the phone down, tells his secretary to book a flight to San Francisco, takes the next flight, and calls from the airport and says, "Okay, now I've been to Silicon Valley, and now will you talk to me?" The CFO says, "All right." He's half impressed, half feeling sorry for this crazy guy. And they meet up, and it turns out that Yuri Milner is the founder of the Russian clone of Facebook. And so he does understand the business model. And he has this multi-country spreadsheet of how social media companies can make money, how it's done in Asia, how it's done in Europe, and so forth. And so he talks his way into Mark Zuckerberg's office, and he does the investment. And he does it with this tweak. He says, Mr. Zuckerberg, I have so much respect for what you've built that I will never take a board seat and I will never vote my shares against you. And so if you take my capital, you will not be diluting your control, you will be enhancing your control. So of course, Mark Zuckerberg loves this. Yuri Milner is invited to do the investment. He makes, a big investment. I think it was more than $200 million. And because Facebook quickly recovers, because it was just the 08, 09 problem that was causing him difficulty, it was the financial crash, it wasn't his basic business. Yuri Milner made an enormous killing on this investment very fast, and everybody started copying him. And that is why you had this sudden surge of big checks into growth tech companies, these established unicorns, that came with no governance oversight. And it goes back to what I was saying earlier about why WeWork and Uber could go off the rails, because they received investments with no governance oversight. And so Yuri Milner was one part genius investor, and he did invent this model. And the second part, he was essentially an enabler of these out of control unicorns, and that's a bad thing.
Where is he now?
He's a funny man of mystery. I would always email him, and I never knew whether he was answering me from his yacht, which cruises around the world, or his office in Hong Kong, or his office in Moscow, or his office or his mansion in Silicon Valley.
Is he considered an oligarch? I mean, is he on a sanctions list or?
No, I actually don't know. I'm pretty confident he would not be in Moscow today. I know that he had backing from a Ukrainian oligarch. So that I don't know how that crumbles, whether that guy's on the sanctions list or not. I suspect that Yuri Milner is probably deliberately either in some place like Singapore where he's beyond the reach of sanctions, or on his yacht or something. I saw that his company DST was making various bets recently in crypto. Being cryptic about his whereabouts is probably part of his game right now.
So before I let you go, first I have to thank you, and you're very generous not to be out tonight at some Jubilee platinum ball. Or tell us what's it like today in London, because the Jubilee celebration starts today and goes through the weekend.
That's right. I mean, there's a lot of crowds in the middle of London. Rather unpatriotically, I've been avoiding those crowds and staying in West London where I live. But weirdly, actually, a friend of mine who lives in Washington, D.C. is in town, and she's the one who's been sending me her pictures of the center and what it looks like, and it looks pretty crowded. I will say that, everybody loves the Queen, and even if you're not particularly enamored of the constitutional role played by the monarchy, which is sort of my position, I do think that the Queen has represented continuity and glue for British society over a very, very long period. And I respect her sort of personal discipline in doing that. We'll see what happens when the next generation takes over, because the monarchy is a lot more popular. The monarchy is a lot less popular than the Queen herself.
Well, of course, the big question for the weekend will be, I'm not sure when we'll see the photo from the balcony, but who's included and who's not.
Absolutely.
Sebastian Mallaby, thank you so much for being with us on this edition of Cover to Cover. And again, I want to encourage everyone, if they've not yet picked up a copy of your latest book, The Power Law, to do so. And this is also, over the July 4th weekend, a good time to read The Man Who Knew, The Life and Times of Alan Greenspan, two really superb books. Thanks again. And Bill Clifford will be back here next month for another broadcast of Cover to Cover.